This one's for me, Romano. What's the bloody stock that everyone's missing at the moment that's really undervalued that could be worth a punt, you think? Obviously, if you're in it yourself, it's beneficial.
Yeah, look, obviously WAF. I mean, I think from here, WAF, once we get some certainty around what that deal looks like, even if it was 50% of Kiaka's given up, the share price rallies because the analysts can actually put out some notes and not look stupid. And people see how cheap it is and how much free cash flow. So obviously WAF. But I think the other one that is looking really interesting, and we've been building a position in it, is...
This is general advice and my opinions only. CFDs are high risk, past performance isn't reliable. I may be long or short CFDs and stocks mentioned. Content may contain language that offends some viewers. LEVRD operates as corporate authorised representative 001318377 under AFSL 548573. You can find our financial services guide via the LEVRD website link in the show notes.
Romano, it's probably not trending in your favour at the moment. Katana Asset Management has got a good positive history of returns, and I'm hoping for your sake that the rebound happens before the end of the year. How are you, mate?
Yeah, good. Nice to be here, man.
Yeah, very much, mate. We just had a brief chat before this started. How did you view the Iran situation early on and now, being a long-only fund and thinking, do I start selling and start deploying cash, and how have you timed it?
Yeah, I mean, as we were just saying, we're a bit surprised at how calm the market was when the bombs started dropping. You know, normally you get that knee-jerk reaction, which is the opportunity to move, but the market was very calm, and we saw virtually no drawdown in the index. We were sitting on just over 20% cash because we'd crystallised some good positions prior to the bombing. We've deployed about 10% of that capital, so we're down about 10% cash now, and we're not going to go below 5%. So we've got about 5% cash left to deploy, and we'll probably look to deploy that on the Victory trade, so on the way back coming out of the whole crisis.
Yeah, and what do you think? Because I guess one of the surprises that most people have said was the lack of reaction by the gold price, but obviously the money really flying out of the equities because everyone was levered up to this very tickly feeling cycle that we were going through where everything just kept going up. Like gold's one example, but where do you think the value is at the moment if you're going to go Woolies shopping?
Yeah, I mean, it's a good question. Clearly, the commodities seem to have been hit a little bit harder, and also, consumer discretionary outside of commodities have been hit a bit harder as well. We think that the gold space is a good space to continue to hunt because it hadn't reflected the gains in the gold price prior to the crisis, and so the sell down, as we've seen, we've seen a $100 drop on the gold price in a day, and we've seen gold equities fall off by 5, 6, 7%. So we certainly think those, and they're very cashed up. They're printing very large free cash flow numbers. So we think that's as good a place as any to hunt at the moment.
How are you looking at the way I'm thinking, the risk I see with myself at the moment, after Northern Star absolutely burnt me the other day, bloody hell. But I see a lot of risk at the moment in producers just in terms of meeting guidance and the potential for diesel disruption, and especially because diesel makes up pretty much any underground mine is diesel, and processing plants, a lot of them are diesel. And I don't know if it's actually hit yet, but I think as smaller places are on, diesel rations at the moment, what's risk do you see a bit of risk in producers tipping in if this sort of drags on a bit and there's fuel supply issues?
Yeah, I think more so, as you've said there, on the actual disruption side than the cost side. It's going to have an impost, no doubt. If you look at something like a Northern Star, the super pit, I mean, that's a low grade, high tonnage, high strip ratio operation. So they're going to be more, the impact of the diesel pricing is going to be multiplied. Something like an underground mine, as is generally much lower tonnes, low strips, high grade, going to be less impacted. We've done a little bit of work, for example, on mineral resources, which obviously we know pretty well. And we sort of think that a $10 impact on the price of oil, US dollars, a barrel impacts EBITDA by about 60 million, give or take. So we were running a base $70 US a barrel for our models. If we up that to say $100 a barrel, which is close to where we are at today, so at $30, that impacts about 180 million EBITDA, which sounds like a lot, but it's round about 8% to the bottom line. So for an operations like MinRes and, with all iron ore ops, that's probably what it looks like, about 8%. So yes, it's an impost, but it's not, it's not a game changer.
Yeah. And has there been any word about, the Pilbara is very highly reliant on diesel for power? MinRes do have iron ore up there, but they've got a lot of contracts up there that are supplied by diesel. Any word on if there is any disruptions as to yet?
Look, not at this time. And to be honest, we wouldn't expect it at this stage. I think we've just had, the first on jet fuel, the first delayed shipment that we've read about. So, we're not seeing anything that's going to impact them this time, but we're probably still a couple of weeks away from that if it's going to occur.
Yeah. And you mentioned gold. If this Iran thing sort of prolongs a bit, what do you think any of the structural commodity setups have changed? And if so, which ones do you think are going to act the most aggressively coming out of this?
Well, obviously the commodity complex that's changed the most is energy for the positive. So, and that's, we're at the moment, we're a long-only fund, but in the directors fund, we're having a look at different put options on oil because we want to be positioned to capture some of the downside in the oil price from here and the whole energy complex, LNG, thermal coal, etc. So that's obviously one that's set up the best going in. Look, I think coming out, a lot of the same themes are intact. We don't see, again, as we were discussing earlier, wars are generally transient events. They're not structural. They don't structurally impact economic cycles or economies unless they're very pronounced. So, we'll see coming out of this the same themes that are intact prior to the bombing. Those will still be intact, and that's still what we'll be looking to play.
Yeah. Yeah, and I guess because I remember you mentioned at the end of last year, the disconnect between gold miners and the gold price, but gold miners and gold prices have probably changed a lot since you've mentioned that. To be fair, the gold price has gone down 10%. It's gone down $500 an ounce, but it's gone down 10%. How are you looking at that as we speak now? I would assume it's probably even more of a disconnect with how much equities have pulled back, or not?
Yeah, certainly. You see $100 price decline in the underlying commodity in gold, and you're seeing 5, 6, 7% drawdown in some of the equities. So certainly the gold equities have been sold down disproportionately to the gold price move during this crisis, and there's a lot of reasons given for that. The most obvious reason is that people are having to fund their other trades, having to fund redemptions and drawdowns, and gold has been one place where there's a lot of profit. So that potentially you've seen some of the money come out of that trade. But in terms of how do we see it, we don't see anything changing. We see the two main drivers, which we've seen for the last 3 years: US de-dollarization and US dollar devaluation. Both those drivers are very much intact as we head out of this crisis. In fact, the USD dollarization is even more intact.
Yeah, mate, I love talking to you about MinRes. Love it. You've mentioned them already, and it is amazing. The share price is about $55. The share price has a really big correlation to how many newspaper articles there are about Chris Ellison and MinRes. They've had a big recovery. They're delevering. The share price is showing it after all the action. I want your overall take. It just is so interesting. I'm sure Stefano's snipping at the bit to find something to write about him. But how are you viewing the business at the moment, mate?
Well, I think the first thing to realise is, pride doesn't come before the fall. Pride guarantees the fall. So, as soon as you start getting proud about a call, you're in for a pineapple. And let's be honest, that trade could have gone the wrong direction. There was a probability, there's a low probability in our assessment. There was a probability the balance sheet where it was and the commodity price where it was. The commodity price could have gone to $80 instead of 105, and the balance sheet could have been under more stress. They might have had to have done a capital raise that was dilutive. Now, we assessed all those outcomes to be low probability, and hence we're happy to increase our weighting into that share price drawdown. And, with the fullness of time, it's worked in our favour. But, we sit here knowing that could have worked against us as well. So, we are very cognizant of that. I think where we sit today, so we've taken roughly about half our position off. It had become very overweight as the share price bounced back. It got up towards 8-9% of the portfolio. We generally don't go above 2-3% in the position size, 4% if we're going to marry it, and sort of 5% if we're there for life type thing. So it's rare for us to have a position size that big. We're back down. It's still in our top 3-4 holdings. Look, we see really good. There was a UBS did a note during the week saying that if you run spot lithium and run spot iron ore price, so you get $94 Aussie a share. Would like to be drinking what they're drinking, but we certainly see continued upside from here. But we have taken some off the table, and we've certainly seen opportunities where we can redeploy that capital.
How do you, as a fund manager, sleep when you're taking a punt like that? That MinRes call you made, like down at the bottom, as you said, that's a big decision to make, to start going overweight on a bit of a falling knife. Mentally, is it like that is bloody stressful times, I assume, hoping that there's a turnaround?
Surprisingly not. I mean, for a number of reasons. First, there's 3 portfolio managers, right? So, each decision is made as a team.
Yeah.
Yes, we have a primary in each position, but, it's a team that makes these decisions. We've made pretty much every mistake possible in the last 30 years. So, we've run out of mistakes to make. I think that, we're pretty comfortable that normally we get it right. We're probably a bit different to other managers too, where we don't separate the outcome from being right or wrong. Like, we can do the wrong thing and get a positive outcome, and we can do the right thing and get a negative outcome. And as long as our process is being solid, as long as we've made the right decision with the information we had at the time, and we've done proper due diligence to get the correct information, if the outcome is negative, we're not going to beat ourselves up. That's part of the investing cycle. That's part of the investing game. Where we're more likely to beat ourselves up is if we, for some reason, there was an emotional interlude or something happened where we made the wrong decision based on what we knew. And so with Mineral Resources, running all the models that we run, and we've got, very detailed models on Mineral Resources, we were quite confident that the risk return upside was substantially in our favour. It's not to say it couldn't have gone against us, as I mentioned, but if it had gone against us, we wouldn't have beat ourselves up because we actually made the right decision despite the outcome.
Yeah. Now, the lithium business, mate, there's are we going to see some levers start getting pulled soon between, look, I've heard the Mount Marion underground contracts out in the wilderness at the moment for tender possibly. You've obviously got Bald Hill, you've got potentially the extra trains at Wodgina that were postponed. Are we going to really see that starting to talk up with SPOD sitting at 21.65 at the moment on the 6% benchmark?
I think we have to take on our payroll there, mate. You've got better intel than we have. But look,
please, I will.
if you look at the incentive price, yes, we're through that. That's probably $1,600-1,800 US, right? So we're through that, and it's been there long enough for companies to draw a little bit of comfort about the fact that it might actually stick. So I think for those reasons, yes. And then I think if you look at the macro, I think BESS has been the game changer. I don't think people understood how quickly, battery energy storage systems are going to suck up lithium. And that's been, it hasn't been the EV vehicles, it's been those storage systems which are growing at an enormous clip. And I think if you put all those factors together, I think it gives CEOs enough confidence to be getting pretty close to pressing the green button.
Yeah. Yeah, and and also even just on EVs, I'll be so interested. I know China's had weak EV sales the last couple of months, but I'll love to see them in the next few months with rising fuel prices, because the human nature will be, I want to buy EVs, and I think I spoke to Matt Fernley about it yesterday. I'll be interested to see if that happens.
I think you're spot on, and not just the cost, but energy security. Suddenly people are saying, well, what happens if we do get petrol rationing? If I've got an EV, there's no problem. If I've got it, so it even just goes from that cost issue short term to the surety issue.
Yeah, very much, mate. All these things that were so under pressure last time I spoke to you a year ago, like they talk about the narratives that have changed. You've long time talked about South 32, but it's amazing what happens when silver price roars, and you've got Cannington, the biggest silver producer in Australia. You've got Hermosa, now the silver becomes very important. You've got aluminium rising during this war, which South 32 have a large exposure to. Their whole stories changes with a few commodity price tweaks.
It does, and I think you've absolutely nailed the two drivers there. We and don't get me wrong, we've traded South 32 many times. There's a time and a place, but as a general comment, we're not overexcited by management decisions over the past decade, and we're not excited by their suite of assets. So yes, you've got a few things lining up them right here, right now, but I think generally speaking, I think that company is in long-term terminal decline.
Even on the share price rise.
Even the share price rise, yeah. So as I said, share prices are an indication of a point in time, and you've nailed it to aluminium and silver. Who would have thought that two tier 2 commodities would be leading the way? But through the cycle, their assets are old and tired. They haven't reinvested in anything that excites us remotely or gives a decent return on capital. They've had a few attempts at copper, but they look B grade at best. We think they've squandered probably most of the cash flows over the last decade. Having said that, we do like the buyback. We've been big fans of buyback in the past, so that's a good thing. But generally speaking, I think you compare the way they've reinvigorated their suite of assets to others, and I think they'd fall behind.
So it sounds like sort of the only way is selling some of those assets for whatever they can get to people that will want them in this market, and then redeploying it into some bigger project to transform the company, which was puts them back on the growth side. Like, is that about their only outcome? Like, there's not many organic outcomes for them that could really change your mind on that.
It's a really good question, because they are caught a bit in no man's land in terms of that size. They're too big to do small deals, and they're too small to do the deals that Glencore, BHP, Rio and Vale are looking at. So they are caught a bit in no man's land there. I think the bigger issue, though, is that, they're trying to move down the copper path at a time when copper assets are anything but cheap and are very much sought after. And any B-grade copper asset, is either relisting or sort of, catching a bid. So I think they've probably got to invest into some really, top quality grassroots exploration or explorers, getting in a bit earlier in the curve, and then trying to put their foot on assets as they're developing down that pathway. I think at the moment, buying old, tired assets that have been squeezed sort of 3 or 4 times, and they're trying to squeeze them again, I just don't think that makes sense where they're at. I think they've got to go back. They're too big to try and compete for some of the best assets out there. I think they've got to try and get a better pipeline of exploration/development assets and get a bit earlier into the curve.
Yeah, very interesting. Mate, you've had a good win on Forrestania. FRS, very well done, mate. Probably the biggest, it's like the Dyson of tenement acquisitions, that company. Was what drew you to it? I assume Chairman and the MinRes connection may have had a part. He's very, very active. What else?
Yeah, well, that was the first thing. Dave Garrity has been a very impressive long-term performer inside of MinRes, and within that organisation, he was very much revered's the right term. He's very much sort of appreciated. They understood the quality and what he brought to the table. So this is Dave's first play outside of MinRes in his own right, and so that was what first drew our team to look at it. But then as we started to understand what he was doing, how he was trying to consolidate that whole region, bringing in the mill and so forth, it all started to stack up and make sense. Now, it's had a a big run, and it's probably ran ahead of itself at sort of 60, 65, 70 cents. And it's pulled back now, and we're seeing some profit taking the like there. But if you bench it on other 150,000 ounce per annum producers, then it's still very cheap where it is today. Very cheap. In fact, a lot cheaper today than it was 2 days ago.
Yeah.
We're cautiously optimistic that Dave can deliver. The approach they're taking is the MinRes approach. It's like you don't go in there and overdrill the assets and sort of create a gold standard. You get in there and understand the assets and learn enough to actually get there and start developing it, get cash flows, and then as that happens, you learn more about the asset as you're starting to produce and continue to drill it out. Now, it's a little bit untried and tested in the gold space. Obviously, MinRes has done a lot of this in iron ore and the bulk commodities in the past. So it will be a little bit interesting to see how it, translates to a gold company. But, I think Dave's done everything right so far in the team as well.
What do you think the big kickers, big catalyst is going to be there? Are you thinking maybe an Edna May deal? They're in the region, or like they're sniffing around close to Ramelius's Rebecca Rowe. There's obviously numerous aspects to the company with Lake Johnson and everything. Like, what are you looking for, like a big catalyst for them?
I think any of those you've mentioned, and I think Lake Johnson gives you your safety net. That's your backstop. If they aren't able to pull off a larger transaction, then you've got an asset that, as they develop the satellite deposits and truck the ore in there, gives you a valuation well above where it is today.
Yeah, very good, mate. WAF just released their full year results today. Like their numbers are very, very impressive. But I even looked. I think I looked on the past 1 month performance during all of this, and they're performing equivalent to Northern Star and Pantoro that have just had huge downgrades. But WAF do deliver, and 500 plus mil cash and 300,000 ounces and growing. So how do you view that? It's not one I want to go leverage on, because things could have changed, but go and leverage on Australian ones didn't work for me either. So how are you viewing the work of Richard Hyde at the moment?
Look, I think people have to realise, there's 7 or 8 things that make up a project, and you've got to give up something for any project. Like in the case of West Africa, you've got geology, you've got management, right? You've got, your costs where you want on the curve. You've got all these things in your favour. What you don't have is the sovereign risk where you want it to be. But I think if you were to take out, say, 50% of Kiaka, and the government's chasing extra 35%, which you get them to 50, which they probably won't get. Let's say you took out 50% of Kiaka in total, and that you ascribe zero value to it. They got despite the mining code, they got nothing for it. You still get a valuation north of $4.50 a share. So as we know, markets hate uncertainty. There's nothing markets hate more than uncertainty. Once you can quantify something and put some numbers around it, and you can value it, and I think that's a big issue. We're stuck in this twilight zone, of this limbo where you can't actually value it, because even if you do the worst case scenario, it might not be that. So you're not going to publish a research note saying that. So I think, I believe that Richard's heading over back to Burkina next week to continue to nut out a deal with the government there. We don't expect to trade on the same level as Australian gold producers, even anywhere remotely close. What we expect to happen is that part of the enormous discount is unwound. And, when you've got it sitting on the latest note this morning from Argonaut, it's got on free cash flow yields 40% this year, 41% next year, 43% the following years. That's free cash flow yields, right? It pays itself off in 2.5 years, the whole company. So we need to see some of that discount unwind, and it will do in time. And then we'll start to see the price re-rate.
You might just have to change the name of the company. Just don't draw too much attention to it, maybe. No, simple. Could be simple fix like that.
Well, going back 5 years, West Africa was a great jurisdiction, wasn't it? So,
yeah, exactly.
That's why they picked up that name, But maybe it's got to change.
Mate, one commodity that you think is going to surprise us this year?
Oh, I don't think it's going to surprise. But I think uranium's the best one to call from here, but I don't think it's any surprise. It's probably the top. I don't think I've got a real commodity that surprises. I think gold remains stronger for longer. I think the drivers are intact there. I think that, this war has done nothing but confirm why you don't want to be holding US dollars. You've got a president that can suddenly go and press a button and do something radical. So it just confirms why you want to be in gold. And I think we're going to see, gold and uranium as being the top two commodities over the next little while there.
And on the flip side, what do you think people are a bit wetted on that might actually disappoint them in a commodity sense?
I'm kind of cheating here, but I mean, obviously oil, with oil at 105 US a barrel, get your puts ready and when the time's right, because there's no shortage of oil. If Trump can do a deal with Venezuela and start to open up, that's the largest oil reserves in the world. Russia will end its war with Ukraine at some point. Those barrels come back into the market. So, there's no shortage of oil. Where we are transitioning away from oil at a slow rate. We are transitioning away. So I think that's probably the easy one to call from this juncture.
Very much. Now, this one's for me, Romano. What's a bloody stock that everyone's missing at the moment that's really undervalued that could be worth a punt, you think? Obviously, if you're in it yourself, it's beneficial.
Yeah, look, obviously WAF. I mean, I think from here, WAF, once we get some certainty around what that deal looks like, even though it's 50% of Kiaka's given up, the share price rallies because the analysts can actually put out some notes and not look stupid. And people see how cheap it is and how much free cash flow. So obviously WAF. But I think the other one that is looking really interesting, and we've been building a position in it, is Metro Mining. It's just coming out of the wet season now. First production will be next week. So they've been through the cyclone season there. They'll probably produce 7 million tonne per annum of bauxite. They'll be bottom quartile globally. It's a simple metric. It costs $8 a tonne to ship it US from here to China, or from Weipa to China. It costs $28 a tonne to ship it from Guinea to China. Massive cost differential. So even the lower grade and everything else there, it's still, hugely up the curve. Now, the bauxite price, unfortunately, has come off quite a bit. And, it's dropped from sort of 70 US approximately to 50 US. So it has come back quite a bit. Metro still make good money here. We think they probably make round about 15 to $16 US a tonne margin here. So that's still a big number for their market cap. But they pretty much will be debt free in the next few weeks, give or take there. So, we think that's one worth doing the numbers. And when the bauxite price does recover, Guinea's talking at the moment now about doing what we saw Indonesia do recently on coal and nickel, which is to put in place some export restrictions. 70% of China's bauxite comes out of Guinea. So if they were to try and get it back to $100 US a tonne, you're going to see a huge re-rating in MMI.
Very good, mate. Sensational, mate. I'll let you get to your afternoon of meetings, and thank you very much for coming on LEVRD. Much appreciated.
Yeah, nice to be on, Matty.
Good on you, mate.